Okay, Assalamu alaikum warahmatullah. So welcome back. Now in this video we are going to see how the lesser accounts for the Ijarah under Financial Accounting Standard number 32 developed by IOFI. So first of all, the lesser perspective, if now something before the start of the Ijarah. So if the Ijarah asset has to be procured by the bank, then the bank will pay, then bank may pay some advance to the vendor, so this will be recorded as an advance. So recording an advance payment to vendor, no underlying asset has been recorded. So this is something which is very usual as per the accounting norms. It has nothing to do with the Ijarah transaction directly. Ijarah accounting as such. So then if the bank receives some advance, bank receives the asset substantially, when the asset is actually receives, so recognize the underlying asset at cost, which includes the purchase prices plus taxes plus all the direct costs associated with the purchase. So the asset is recorded, and of course the vendor liability is credited, or if it is cash, so cash is credited. And then eventually the uh, Ijarah contract is signed. So when the Ijarah contract is signed, there may be some other costs which are related to the development of the Ijarah, so which are also recorded as the initial direct cost, and they are do not part of the asset, but they are also deferred and amortized over the period of Ijarah. Now this is something important to understand, that this will also become a sort of a intangible asset which will be amortized, so it will be a deferred cost on the part of the lessor in the books of the lessor. And if there is any advance received from the client to whom the Ijara asset is eventually to be leased, given, then that advance has to be recorded as an advance, not to be recorded as an Ijara income, because Ijara income cannot be recorded unless the asset is going to be used. So during the lifetime of the Ijara, so what are so first of all, uh, every year the lessor need to record the depreciation, which can be either on the straight line method or it can be on the other method. Then the lessor also has to record the Ijara revenue. So again, for the Ijara revenue, there are two methods. One is the straight line method and the other one is the effective rate of return method. And finally, if it is an MBT, so eventually the title has to transfer. So the period, and towards the end of the period of Ijara, there has to be something to record for the transfer of title of the asset. So we shall see this all in this and maybe one more video. So we demonstrate the entire accounting with the help of this example for the lessor. So there is a bank, an Islamic bank, who is leasing the server cluster, which is a set of servers for high performance computing to say a company, a corporate. Initial cost of the asset to the bank is $120,000. Ijara term is 4 years, and effective profit rate is 12.59%. So this is something which has already been given, although it can be calculated. So from the financial calculator, we can calculate it, but for the accounting purpose, it's usually given. So annual rent or ujra, the ijara terms is $40,000. So it means $40,000 multiplied by 4. So how much we are uh, going to receive as a lessor? So 160,000 over a period of 4 years. And it is Ijara MBT via gift transfer at the end of the term. IOFI, IS 32, FAS 32, IOFI standards applies. So recording the asset, so Ijara asset has to be debited, recorded on the left hand side of the equation from the accounting equation perspective, and another asset cash has to be reduced or credited. Now for the accounting for the first year, in which we have to record different Ijara related transactions, again there can be two methods as we discussed in this slide. If you recall, there can be a straight line method and there can be effective rate of return method. So we shall demonstrate both, right? Although for depreciation purpose, straight line method, demonstrating straight line method is sufficient, because depreciation is not something specific to Ijara. It is a general accounting thing. I think all of us are aware how there are other methods like diminishing balance method and years, some of the years digit method and usage method. So right, so we are not going to go beyond straight line method in this, but over here we should see both the scenarios. So the first scenario we see over here is a straight line revenue recognition. How does it happen? So first of all, towards the end of the period, we say that okay, accrued Ijarah rentals, which is a sort of an account receivable. So if we have a receivable of 40,000 from the client, and this is our gross Ijarah revenue, this is the Ijarah rent revenue. So on one side of the equation, asset increases; on other side of the equation, equity increases by virtue of revenue. Then when we receive this cash from the customer, so cash debited and Ijarah rentals receivable or accrued Ijarah rentals credited. So eventually this receivables become zero. And for the depreciation, the total cost was 120,000, 4 years was live, so 30,000 straight line depreciation. So we simply record depreciation as an expense and a reduction in asset or by means of a contra asset. So straight line method is relatively very clear. There is no much calculation involved. Whatever is received is recorded as Ijarah income. So even we can combine these two entries and we can simply say that cash is receiving and gross Ijarah revenue is increased. So there are not much complex calculations involved. So what's the impact towards the end of the first year and up to the end of the 4 year under the straight line method? So the Ijarah asset will become 190,000. In year 2 it will become 60,000, and in year 4 it will become zero. There is no balance in the accrued rentals, Ijarah rentals, but we will see that in the effective interest rate there will be some balance over here. And for the income statement, it's a consistent income 40,000, 40,000, and it's a consistent expense. And if there is any amortization of deferred cost, which we discussed in the earlier at the start of the video, that can also come as an expense. And we have an Ijarah revenue of $10,000. So this is quite simple, straightforward, but it is not usually endorsed by the accounting experts. Why this is so? Because they used to say that initially the investment in the asset by the bank is 120,000, and towards the in the third year the investment in asset is just 30,000. So when you are receiving the same amount of rent when your investment is 30,000, and you are receiving the same amount of rent when you are investing 120,000. This is not uniform. This is not the just calculation distribution of income. So that's why the effective rate of return method comes into play. So in the next video we shall see the effective rate of return method.